In New York, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, the biggest shopping spree in the world? No, not Black Friday. It's Alibaba's Single Day, and it's this weekend. We speak with e-commerce giant's president, Mike Evans. Plus, the race for Amazon's second and potentially third headquarters is reportedly narrowing. And while there's excitement in the cities on the short list, are they ready for the tech giant to set up its digs? We'll look at what's next for HQ, what that means for transportation and infrastructure. And 2018 has been an incredibly strong year for tech IPOs. So what does this future hold? A look at 2019 IPO outlook later this hour. But first, to our top story. Alibaba's annual shopping event happens this Sunday. The Singles Day extravaganza brings in roughly twice the value of Black Friday and Cyber Monday combined. Bloomberg Technology's Selena Wang caught up with Alibaba President Mike Evans in Shanghai and asked if trade tensions will ultimately impact this year's final sales numbers.
11/11 is not an event that relies exclusively on any one market, the U.S. or any other market around the world. So we'll be working with over 200 countries and regions as part of this enormous event. And so we don't expect any one area to have a huge amount of influence other than China, of course. So we're not too concerned about trade tensions between the U.S. and China as it relates to this specific event. In terms of the China economy, there's certainly more concerns that are being expressed today and some uncertainty about what will happen going forward. Having said that, an economy that grows at 6.5% is still growing very well. We reported our earnings last week, and one of the things that we talked to people about was we see some softening in the big ticket items like consumer durables, washing machines and televisions and big ticket items, automobiles. But in other sectors of the economy, particularly in things like cosmetics and food and fashion and apparel, we still see very strong growth. So there will always be some cyclical impact that we'll have to deal with. The long-term secular trends are a big part of what we're focused on. More and more people coming into the middle class over the next 5 years, about another 300 million. More and more of our business incorporating both online and offline, so that's expanding the pie in which we're participating. So we feel pretty good, and our 53% revenue growth in the last quarter seems to confirm that things are holding up nicely.
Mike, that's true, but I want to zero in on American brands, which are hugely popular on the Alibaba platform and generate significant sales on Singles Day. I mean, do you expect sales from U.S. brands to be lower as a result of China retaliatory tariffs on U.S. goods, as well as a somewhat dampened consumer sentiment?
Actually, Selena, I'm not expecting those sales to be lower at all. There are about 10,000, actually a little bit more than that, American brands on our platform. We love them. More importantly, our consumers love American products and American brands. For this event alone, we have 180,000 brands, Chinese and from around the world, who are going to participate. So, as I said before, any single market or brands within a single market, including the U.S., are not going to have a significant impact on the overall result. But we are very excited about the brands that are participating, whether it's Johnson & Johnson or Mondelez or any of the other U.S. brands that are going to be showing up this year, because their products in particular are in huge demand by Chinese consumers.
Now, Mike, we're just days after the midterm elections. It'd be great to get your thoughts on your interpretation of the results and how it may impact a potential trade deal when Xi and Trump meet at the G20.
You know, those election results just happened. I've been over here. They don't get as much play in the China market as they do in the U.S. market. Looked like both parties did pretty well, and I think it's far too early to tell how that might affect the G20 meetings and President Xi and President Trump meeting together in Buenos Aires. Far too early to tell.
The Chinese government, however, has been cracking down on the internet sector. We've seen tighter regulations impact Ant Financial and Tencent. What's the effect been on Alibaba, and how are you managing that relationship with the Chinese government?
You know, the relationship with the Chinese government, Alibaba, is very similar to the relationship that we have to have with governments all over the world. We have to listen carefully to their concerns. Look at the focus on GDPR in Europe and in the US. Data is a big issue over here. Technology is a big issue in all countries around the world. I spend a lot of time with governments all over the world where we're building our business. I hear the same things from them, the same concerns and the same questions as we hear in China. So I don't think it's particularly special about what's happening in China, other than the fact that this is a very big market and the technology companies are very large. Same is true in the US.
Now, Mike, Alibaba has a clear commitment to expansion in Southeast Asia, but what are you focused on now in the U.S. now that Jack Ma has said the 1 million jobs plan is no longer a priority here, as well as the geopolitical tensions?
Well, first of all, it's not just our globalization plans are not just Southeast Asia. We have a very big business in Southeast Asia. We have embassies which are responsible for cultivating businesses in local markets all over the world. We have a business in South Asia. We have a business in India. We have a very large business in Russia. And we purchased a business in Turkey. So we have businesses all over the world. Our expansion business, our opportunities in the U.S. remain significant. But the biggest opportunity is still to import great American products for the Chinese consumer, both B2B and B2C. And I don't think it's not correct to say that Jack has given up on our initiative to create jobs in the U.S. for small businesses. Our small businesses activities in the U.S. have been extraordinary. Billions of dollars of products for thousands of small businesses we have sold to Chinese consumers in the first 9 months of this year, and we're very proud of that. It is a little bit more difficult if tensions between these two governments continue, because we don't want to get caught in the middle of the political discussions and geopolitical discussions, which are also important when we're trying to do corporate business. But we continue to work very hard with small businesses in the United States, and we're very proud of our results.
And speaking of U.S. companies, Alibaba has partnered with Starbucks for coffee delivery and boosting its digital brand presence in China. Do you have other partnerships like that in the work with big U.S. brands?
Well, as you know, we have thousands and thousands of U.S. brands on our platform. We look to think very carefully about what strategic opportunities would exist. Starbucks is something that we worked on for a long time. And I know Kevin is very pleased with the results, and you could see it reflected in his stock price last week when they announced their results. But that's just the beginning of the type of relationship that we want to have with brands who are thinking not just about what they can do in the China market, but in markets around the world. We also, as you saw recently, announced a terrific partnership with Richemont and NAP in the luxury sector. That affects not just Richemont and NAT, but all of the 950 brands that are in the NAP stable, many of which are luxury. And of course, those represent huge opportunities for consumers, but also for us to think about strategic partners with them in the future as well.
And Mike, just real quick, you were a partner at Goldman Sachs running Asia operations when the 1MDB scandals happened. In retrospect, what did Goldman miss? What could they have done to avoid this?
You know, I've been out of Goldman for more than 5 years now. I'm not involved with the investigation or anything that's happening to it. I think really probably best to speak to Goldman Sachs about that rather than me.
That was Alibaba President Mike Evans with Bloomberg Technology's Selena Wang. And coming up, Amazon's potential arrival in Long Island and Crystal Springs, Virginia. But while the company says its new headquarters could bring in 50,000 new jobs, how will the arrival impact commuters? And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Now on to Amazon, and the city's in line to house its next headquarters. Bloomberg has been reporting that Amazon is in talks to split its second headquarters between Long Island City and Crystal Springs, Virginia. And in both cities, excitement surrounds the potential for 50,000 new jobs and $5 billion of investment. But while real estate developers and businesses expect an economic boom, some people are worried about what Amazon's arrival might mean for transportation and city planning. Here in New York, where more than 5 million people ride the subway every day, Friday, many expect Amazon could bring delays, overcrowding, and major closures. Here to discuss is Gabe Klein, co-founder of CityFi, an urban change consultancy startup. He also served as commissioner to both Chicago and DC's Department of Transportation. Gabe, I want to kind of break down the actual impact here. Amazon's saying 50,000 new jobs. That might be split 25-25 between these new cities. How big is an influx of that many employees actually going to stress the infrastructure of cities?
It really depends on how close people live to where they work. I mean, the nice thing about Crystal City, which is the place that they're looking at right outside of D.C., it's one metro stop outside of D.C., there's a tremendous amount of high-density housing there. There's a lot of office space, and there's the opportunity to build more or even repurpose some space. So I think that bodes very well. But additionally, because we're a tri-state area like New York, there's the opportunity for people to live in Washington, D.C. or to live in Maryland and take the metro. We definitely need to put more resources into public transit and public transportation, and we now have a dedicated tax for that, which I think is probably one of the things that Amazon is looking at. But the idea that they might split 25,000 in Queens, 25,000 in Crystal City also takes some pressure off of the system.
So when I think about Amazon's presence and its main HQ out in Seattle, they have helped with funding some of the transportation there and building some of those things out. When you say we need to build out infrastructure, is that just the public sector? How much is the private part of that partnership important when it comes to dollars being put toward more transportation infrastructure?
No, that's a great point. And I think in Seattle, you had the combination of Amazon, reinvigorating an entire part of the city and good city planning. Actually, a good friend of mine ran the Seattle Department of Transportation. They had a very close partnership with Amazon, and I think the result of running public transit, streetcars, putting in separated bike facilities, and other things that they did led to not a lot of pressure on the transportation system, as well as, look, a lot of people say there aren't really transportation problems, there are land use problems with transportation symptoms. So the more people we can get living close to where they work, the better off we are in terms of not putting pressure on that system.
And Gabe, I did live here in New York for 5 years, and I can tell you there is pressure on this system. Subway delays seem to be coming up more and more often these days. When it does come to land use, I mean, Long Island City is in a tricky spot because it is right near this Manhattan metro. You are the master of people before automobile transportation. Can you kind of talk through what you see some of these cities that are close to New York or say DC could do in terms of bike sharing or jumping on the scooter craze that we're seeing?
Yeah, I mean, in many cases, we're sort of overthinking the solutions to the problems. We need to really think about use case. And when you look at, 60% of trips in urban areas being less than 5 miles, when you look at 60% of trips less than a mile in urban areas being taken by car, there are some obvious solutions to that. And yeah, I was able to work on putting in some of the first big bike sharing systems in the US, here in DC and Chicago. And they are absolutely essential, I think. Bikes, scooters, electric, personal, and shared options are absolutely crucial. It's a much smaller format or envelope. It's easy for people to use. It's zero or low emission. And just puts much less pressure on the system. So you have Elon Musk building Loop underground and all of that. And I like the idea of long underground or above ground high-speed rail transportation. But in cities, we have so much space that we can reallocate away from single occupancy automobiles and to more efficient modes.
And Gabe, you just, perfectly opened the door for me there. I got to ask about that Mark Benioff, Elon Musk tweet exchange that we saw earlier. Benioff saying, hey, we need a high-speed rail between San Francisco and areas like Marin County or all the way down to LA. Tweeting at Elon Musk, who said, can your boring company do this? And he said, yeah, sure, of course.
Yeah.
Is that a reality? Do we see that in the next couple of years?
Well, here's the thing. I'm very supportive of the private sector jumping in and innovating and utilizing technology, particularly to make government's life easier and ultimately citizens, particularly when it's in partnership with government. When you think about tunneling underground or running high-speed rail above ground, I'm agnostic. For that type of distance, whatever works, whatever people will get behind, get excited about, and we can get funding for, I'm fine with it. When it comes to those shorter trips in urban areas, let's say 1 to 5, even 10 miles, I just think that we have such inefficiency in the way that we use our existing ground transportation system with single occupancy cars everywhere. And I think Elon, and probably Mark too, should know that with autonomous vehicles, autonomous connected shared vehicles, we're going to free up to 2/3 of the capacity on our roadways. So we may actually have too much capacity, not enough.
So, Gabe, quickly here, you have worked with a lot of cities, Chicago, D.C. What is the #1 thing that was the kind of light bulb moment that you've seen from the public sector that they were like, aha, we need to do this?
Yeah, I mean, honestly, there's a bunch, but I would say looking at use cases, right, and figuring out, like, if somebody's traveling 1 mile, 2 miles, 3 miles, what do they really need? And listening to the public. People like Spin this week sold to Ford. I advise Spin. And, I think you have car companies waking up and saying, wait a second, people are screaming for this stuff. So whether you're in government or you're in the private sector trying to reinvent your business model, let's look at what people are asking for. And they're asking for really simple, high quality, inexpensive, low emission solutions.
Well, CityFi co-founder Gabe Klein will have to leave it there. Thank you so much for joining.
Oh, thank you so much for having me.
Apple and Amazon have struck a new deal to get the newest iPhones into the hands of Amazon customers. The companies already reached a deal to bring Prime Video to Apple TVs. Now the latest Apple iPhones, iPads, Macs, watches, and accessories will be sold on Amazon's website. But the new deal does not extend to Apple's HomePod speaker, which does compete directly with Amazon's Echo. And coming up, is the investor love affair with tech stocks over? We'll look at what's next for FANG stocks. And Bloomberg Technology is streaming live on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Now, tech stocks have been the big losers in the global equity rout, but what can we expect in terms of a rebound? For investors, continued focus on social media's role in policing itself, higher interest rates, and a growing trade war with China could indicate tough and expensive times are ahead for the FANGs. Bloomberg News cross-asset reporter Luke Kawa has been watching the markets. Are you seeing any ebbing of this worry around tech stocks right now?
What's been interesting is that even off the bounce that U.S. stocks got off the October 29th low, tech helped lead the way. But you then look at derivatives markets. If you look at the NASDAQ 100's VIX equivalent, it's VXN, compare that to the VIX. The spread between the two stayed very elevated even as tech was helping lead stocks higher, which kind of suggests that traders keyed into the fact that whatever this equity story is, it's about how do we value tech, how much are we willing to pay for each dollar of tech earnings going forward compared to the average stock. And so far, the answer has been less and less and less on every pullback.
And to me, from the investor seat, those seem like very obvious questions. How much should we be paying for every dollar of earnings? Things have been a little inflated in terms of the answer. Why? What do you think is mostly driving perhaps a bit more caution when it comes to the premiums they're slapping on these high-flying tech companies?
I think the rise in interest rates, we essentially had a 40 basis point rise in the 10-year, and nothing seemed to happen for a little while. And then it kicked in that, like, wait, we have to discount future cash flows by these higher interest rates. And when you look at long duration assets, well, a lot of the value for tech companies or a lot of their expected earnings are at a terminal value X years down the road. X is a long way out. When they finally turned on the switch from growth to more profitability. Mm-hmm. And so when that's kind of your model, the incremental rise in interest rates would seem to hurt you more. So I think it's a factor of that. And then also this notion that, value stocks have been out of favor for so long. You've had a momentum play going for a while and just a kind of factor rotation. That seems to be at the heart of a lot of the move out of tech stocks that you did see throughout October.
But it kind of seems to be the biggest names. I mean, you I watch the IPO sector very closely, and those growth stocks have been doing really well. In terms of the Facebooks, Apples, Netflix, Alphabets of the world, is this an overcrowding issue? Are these trades just been sat in for too long by too many investors who have them in too many indices, too many ETFs? Is this overcrowding?
Hey, you should be on this side of the table. I think that's exactly it. I think that's what distinguishes the sell-off that we had in October versus February. February was a very systemic correction in terms of everything happened at once. It was a vol shock. It was very panic selling. This one, it was fund managers who were in these names just getting absolutely slaughtered and all moving out at once. It was much more orderly in that way, and because of that, you didn't see quite the same spike in volatility metrics as you did in February. But very, very painful nonetheless is what we've gotten here. And
I am a little bit curious on the timing. We're moving into the end of the year here. In my experience, investors don't like to make a lot of sudden moves toward the end of the year if their returns are looking good. This rotation out, is this anything have to do with the fact that we are at the end of the calendar and they're going to have to kind of prove those year-end returns?
I think it's a bit of a double-edged sword in that, because if you did have these guys, it's a matter of locking in gains. If you were able to get out before a lot of the carnage, at least, you'd have something to show by year end. I think a lot of portfolio managers were essentially trying to protect gains. So I think that did play a role in why some are out. However, the flip side of the coin is that fourth quarters and historically after midterms have tended to be very strong. So there's been this idea that we'd get a big beta chase, that fund managers would then repile in to these big high-flying names in an attempt to salvage their year if they've been underperforming. So far, it doesn't look like that's been the case. And interestingly, it's not like they found a fresh place to crowd into, because that value factor, it's actually underperformed momentum since the S&P 500's last all-time high. So it's really a case of nothing is working, but tech getting hit especially hard on downdrafts.
A tough time here for active investors. Why do you think that is? I mean, you seem surprised that folks haven't looked back to these stocks after the earnings cycle, now that we're a few days past the midterms and we have some clarity what the government's going to look like. Why do you think that hasn't happened?
I think it's a bit of what we saw in the couple sessions after the midterms was Pravichinta Wongvanich at Wells Fargo. He had a really good analogy that, for an earnings report, you have high implied volatility, options of showing a high move for a company stock before an event. This is pretty much the same thing. It's an earnings report, but for a country. And so once that volatility event passes, you get a little run up, but then it's kind of back to normal, and it's still the same question that people haven't been answered of how much are we willing to pay for these if we're approaching an end of the cycle, and if we think that, these names are economically sensitive. Because the idea that some huge advertisers aren't economically sensitive, I think we've thrown that one in the bin.
Well, Luke, I know you will continue watching the FANGs and the rest of the asset trading market going forward for the rest of the year here. Bloomberg's Luke Kawa, thank you for joining us. Coming up, 2018 has been quite the year for tech IPOs. Could 2019 be even bigger? We discuss the most anticipated tech IPOs next. And later in the program, Stanford University, the home of the Cardinals, and now it's the home of the top-rated business school in the country. We'll tell you why. This is Bloomberg Technology. I'm Alex Brinke in New York, in for Emily Chang. 2018 has been an incredibly strong year for IPOs, especially in the tech sector. We've seen companies like Xiaomi, Dropbox, and Spotify all hit the public market. And in 2019, we could see some of the most anticipated tech IPOs with the likes of Uber and Airbnb dropping hints of potentially going public. Joining us now to discuss is Duncan Davidson, General Partner at Bullpen Capital. Duncan, I'm just so excited to talk about going public. I'm almost saying you're going public, but there's actually a lot in San Francisco that is happening around this space. In terms of this change in momentum, I think back to a couple years ago when everyone was saying, let's stay private as long as we can. What has been the catalyst here to bring some of these companies to come around to actually getting out and listing?
The companies are getting mature. We're at the end of a very, very good tech cycle, so it's about time for them to go public. Alex, I've been through 3 of these cycles, 80s, 90s, and now. We had many, many more IPOs back in the 80s and 90s. It's actually, next year might be a good year, a lot of marquee names, won't be a great year. We should be seeing around 3 times the number of IPOs we're seeing right now.
So, Duncan, I want to tap into some of that historical knowledge that you do have. You've seen a few of these cycles. I get the question very often, with this many companies going out, does this kind of foreshadow a bubble like we saw in 2000? That was the last time we saw this many large tech companies, more than $1 billion potential listings, getting out the door. Does this foreshadow some kind of a bubble here?
I think not at all. We had more IPOs in 2015 than we had in 2018. I don't think 2019 will exceed 2015 in numbers. I had 2 IPOs in the bubble in the 90s, so I lived through it. Again, we should be having many, many more of these companies go out. We've made it really difficult to go public, and as a consequence, most people stay on the sidelines and instead are taking money from all these new mega funds like the SoftBank Vision Fund. This just locks them up for a much longer time in the private markets. I'm actually a fan of tech companies being public. I would think if Uber had gone public years ago, Travis would still be running it today because he would have been policed much better by the public markets. We wouldn't have seen Theranos and the huge fraud if that had been a public company. So I'm a fan of companies getting out in the public markets. They're better regulated, they're better understood, and it's better for everybody involved.
And that governance issue is an interesting one, and it's one that has been brought up more often these days. I mean, historically, companies list why for capital raise or acquisition capital, but they're doing that privately now, to your point. In terms of governance, when you talk to portfolio companies who are looking to get closer to listing, what are the top things on the mind when you say, look, moving into the big leagues of being a public company, these are the things that management needs to be focused on?
Well, first of all, steady earnings. They need to have predictable earnings. That's probably the biggie. Second, they've got to upgrade, certainly the financial side, because you have to deal with the quagmire of Sarbanes-Oxley. It's actually much more expensive and complicated to go public today. And the third thing, they've got to stay long-term. You look at the best tech companies, Apple, Google, they didn't go to quarterly earnings. They didn't go short-term. They stayed long-term in their research and development and their planning for markets. I think number 3 is often overlooked, the most important thing of all for tech companies.
When you do think about general sentiment, public tech companies, those stocks have obviously been hammered over the last few weeks here, and it doesn't seem like they're getting any reprieve. How much does watching the Facebooks, Apples, Netflix, Alphabets of the world change the decision-making process for management teams that are looking to go public?
It shouldn't change it much. Those are the FANGs were extraordinarily overvalued, incredible companies. But I must tell you something. If you look at the tech sector, even today, or even a few months ago when it was higher valued, and compare it to the 1990s, the disparity of valuation to earnings is much, much lower today. These companies are not in any way bubble stocks. I just think we're seeing a normal sort of rotation out of one sector that's gotten to be too big a percent of the total market into other sectors. I don't think it in any way indicates real trouble in the tech sector.
So then do you see this as potentially a buying opportunity for companies whose valuations are depressed? Put yourself in the shoes of a public market investor. Is this actually a plus that things are potentially a little cheaper?
I think it's a real plus for the next layer down of companies. You know, we're having, as I said before, marquee companies have gone public or going public. Some of these will generate incredibly strong earnings. I would focus on them. The leaders are the leaders, but there's a level below which are really strong future companies with more appreciation baked into them.
And a lot of those leaders are consumer tech, and we have not seen a rush of consumer tech companies. The bread and butter for new listings has typically been out of the enterprise. We're about to potentially have a really big moment with Uber, with Lyft, potentially Airbnb, Pinterest, House, all of these names getting thrown out there. Why do you think consumer tech is having this moment right now of companies finally being of the maturity that they could look to be the next big public company?
Well, they're extraordinarily well-run, fast-growing companies. It's extraordinary. The rate at which Uber or Lyft have been generating revenue and transforming our lives is just mind-boggling. And there's more behind them like this. Certainly the scooter companies will eventually get to this point. We're seeing a complete transformation of mobility in this country. That's why they deserve and are getting these really high valuations. But I will point out there's a lot of really good B2B companies that have been going public, and there's some more going out over the next year or so. Some of them in the security area, some of them just in SaaS. These companies are also being well valued, but they're very good very steady, predictable earnings companies. I would look there and not just on the big, sexy, glossy companies that get all the headlines.
And I want to kind of break down into that SaaS group a little bit. We do have a name that I know a lot of folks are excited about. Qualtrics is on the road right now. They are looking to list. They are a competitor to SurveyMonkey, which just listed a number of weeks ago. In terms of software as a service companies, when you break down under the hood of what sectors you think will be busier, is it security? Is it software? Is it more of these software type applications? Where gets you really excited in the enterprise space?
Well, some of the security ones get me excited. I think Cloudflare is going to go out. We have Tanium in the future. But the other place is just core enterprise applications. There are things in like Workday is a big company with HR, but there are some other up-and-comers doing HR to a broader market. I would look there. Security is actually highly invested in, so in effect, it's too competitive. But a lot of the core SaaS companies doing core enterprise functions look really solid, and they can have a fairly strong lock on their market sectors.
And, you know, I just do want to point out the last time 3 11-figure U.S. tech companies went public, it was the same year Bill Clinton was president and Apple was worth less than 1% of Microsoft. So quickly here, can you characterize the excitement level of 1 to 10 being through the roof in terms of how jazzed you are for listings in 2019?
Well, I am jazzed 7 or 8 in the quality of the companies. I'm not jazzed in the quantity getting out because a lot of people are avoiding it. To give you an example, one of our companies we decided to take public in Australia. Why? They have the 1990s rules. They're very friendly to the retail investor. We shouldn't overlook the fact that we changed the game. You put $10,000 in Amazon in 1997, you're worth close to $10 million today. A normal retail investor could get rich off of tech. We were democratizing wealth creation in this country. When we made the changes to IPOs, it became an insider game, and all the insiders get all the money, and the retail investors left out.
Well,
so we went to Australia in part because they're still a retail-friendly market for IPOs.
Unfortunately, we're going to have to leave it there. Bullpen Capital General Partner Duncan Davidson, thank you so much for joining us. Coming up, the Stanford University Cardinals are coming off a close loss to rival Washington, but the school claimed victory over its NBA rival schools. Find out how next. Plus, guarding against cyber threats, we look at the state of cybersecurity and how Symantec is keeping the digital world safe. This is Bloomberg. Stanford University is standing tall in the battle of the business school. That's according to our own Bloomberg Business Week. After surveying more than 26,000 MBA students, alumni, and recruiters in 2018 about their goals and experiences to find the best schools in the U.S., a West Coast institution has shaken up the ranks. And the winner was Stanford, which jumped up 5 spots from its ranking last year to beat out both Wharton and Harvard. Earlier, we caught up with Bloomberg's Carol Masser and Jason Kelly, who were on the campus to find out just how big a role tech played in the university's rise in the rankings.
Well, it definitely, Alex, plays a big role in terms of here we are in the heart, as you said, of Silicon Valley, right? Surrounded by such well-known tech giants. So entrepreneurship was one of the main indexes that was used in ranking the MBA programs around the country. And for Stanford, they ranked #1 when it came to entrepreneurship. They also ranked high in terms of networking. They also ranked #1 in another category. I'm trying to remember. But it was kind of interesting. But entrepreneurship is certainly a key part of the component and the rankings.
Are they tapping into any kind of new technology? I mean, the companies across the board in non-tech industries seem to be getting on AI and data analytics. Are we seeing this at the university level as well?
Absolutely. I mean, they are certainly investing heavily in that. And one of the interesting things that came up in that regard, as we've been talking to people here, is this notion of corporate entrepreneurship and really marrying sort of innovation, sort of out of the, kind of 2 guys in a garage and into the bigger tech companies, whether it's the established tech companies like an Intel or a Hewlett Packard, or, a more recent giant like a Facebook, a Google, and the like.
You know, it's interesting, Alex, I just want to add on it, and compensation was the other index that was very important, and that Stanford ranked #1. But we caught up with Dean Feinberg, a senior associate dean here, earlier to talk about the program. He's also involved in running a program called Ignite, and it works with entrepreneurs who are interested in starting businesses. So it's kind of I think a mini MBA program. So they're thinking about people who are already out in the world and how can they kind of hone their skills if they're thinking about starting a business. So it really is front and center, this entrepreneurship idea.
Where are they sending these new graduates? When I think of tech, I think of engineers perhaps who are going back to get their MBA, to learn leadership skills. Where's the kind of end goal for a lot of these students who are going to get their MBA from Stanford?
Well, it's a great question because, and we pose that to Dean Feinberg because he ultimately, these schools are judged on where the graduates go. This is an investment, after all. This is not, you know, the sort of program you come just to kind of find yourself. No. You want to invest and get a good job. So we pose that to him, and here's what he had to say.
What we see is that the traditional career path for MBAs, has changed dramatically.
Yeah.
Right now, what we have is graduates that go into, you know, more than 300 different career paths. And when you have that, it's really about preparing them with the core skills of leadership. It's being technically savvy, it's being, again, scientifically well-founded content, and at the same time having the leadership skills, having the team community building skills that are going to be applicable in each one of those career paths.
So it's interesting to hear Dean Feinberg, and Alex, he did talk a lot about leadership, and I think it's so timely when we look at political leaders, look at corporate leaders around the world. Folks, you know, there's so much divisiveness around the world that the importance of the tone sent by today's business leaders, that was really important in terms of their programs here at Stanford, really key. I just want to point out, too, that while still the bulk, right, Jason, of graduates go to the financial world, about a quarter of the graduates go into the tech community. I think it's the second most area of business that the graduates go into. So obviously a big component.
Yeah, and obviously this is a new world that doesn't just send MBA graduates into consulting, into Wall Street. This is the hot place to be, and it's one of the reasons that Stanford is #1.
And that was Bloomberg's Carol Masser and Jason Kelly. Now to the Web Summit in Europe, Europe's largest tech event held in Lisbon this year. Founders and CEOs of tech companies, fast-growing startups, policymakers, and even heads of state gathered to look ahead to the innovations that may come. Bloomberg's Anne-Marie Horton sat down with Medium CEO and Twitter co-founder Ev Williams to talk the future of tech regulation. Take a listen.
The system's working really well that we have right now. What we've really figured out in the last year and a half is how to offer an open platform that allows everybody to, or anybody to come along with a story or idea and help it find its right audience. And we combine that with professional editorial team and a curation team that both contributes content and works with professional writers. And that all goes behind this paywall that is driving subscriptions and then enabling us to pay more and more every month for content. So the challenge right now, or the focus, is really to scale that in all ways, to really work on personalization is a big part of it. So helping people find amongst the thousands of stories published every day what they really care about is a big focus. And then we're hiring a lot as well, and it's a competitive market, so there's that.
How do you deal with fake news?
Fake news is we actually choose to have this curation layer, which I mentioned. So everything that we distribute on Medium, anyone can publish on Medium for free. So of course there are bad actors and people who, not just fake news, but just low quality or spam or all the things that can happen when you have an open platform. And so we don't distribute anything on Medium unless it has been seen by a human, except if you're directly following someone. So there are cases, and we'll host things, and there can be, if we're made aware of it, we have a trust and safety team, and if it violates our rules, we'll take it down.
Do you think Twitter has made enough progress in combating the spread of fake news? If you put your old CEO hat on?
Well, I'm still on the board of Twitter, and so still in some of those conversations. I think there's more to be done at Twitter, and other platforms, I think there's a major effort, I can tell you, and I think there improvements have been made.
Do you think that they did enough to prevent some of the undue influence we just had in the U.S. elections with the midterms?
I haven't heard the full report on that, actually.
How do you rate Jack's performance as CEO? Is this a job someone can handle alongside being ahead of other companies?
Having another job?
Yeah.
I think a lot of people are skeptical of that, but I've been impressed with what he's done. I think the company is in a much better place than it was a couple years ago when he took over, and that is true. I mean, there's a lot of external evidence that that's true, and when you talk to people inside, I think that is absolutely endorsed.
Tech has taken a big stance on some people like Alex Jones in this space. Do you think it suggests the industry could self-regulate if they collaborated more together?
I think collaborating is important, and there could probably be more collaboration. And I think everyone's interests are aligned in not just for the tech industry, but from the most of the humans I know in Silicon Valley are aligned, not necessarily politically. I think that's actually overblown a bit, that they're all view things the same way, but everyone recognizes when there's bad actors or misinformation is not only not good for platforms ultimately, but it's not good for humans. And so I think Twitter was in a little different position than the other platforms when it came to Alex Jones for a while, and ended up eventually removing him, but they made their own call on that. They didn't do it because Apple or Facebook removed him.
That was Medium founder and CEO Ev Williams with Bloomberg's Anne-Marie Horton at the Web Summit in Lisbon. Coming up next, our interview with Symantec CEO Greg Clark on a potential takeover and how the cybersecurity firm is stepping up its cybersecurity efforts. This is Bloomberg. The tech tension between the U.S. and China keeps on intensifying, from the protection of IP to the reported supply-side hacks and potential cyber espionage. To get the latest on this, Bloomberg's Selena Wang sat down with Greg Clark, the CEO of cybersecurity company Symantec, to find out if he sees China as a cybersecurity threat.
China has been attributed with many pieces of what we call advanced persistent threat malware over the years. And the agreements that President Obama made with the Chinese government was I think a landmark one. We have seen an increase in activity, in recent times after that. But I do think we are in a situation where nation-state espionage will continue, and we have to stay very diligent on how we protect ourselves against it.
Now, Thoma Bravo has invested heavily in cybersecurity, and it's been reported that the private equity firm was interested in taking over Symantec. What can you tell us?
So we don't comment on rumors or speculation.
But what can you say about strategic options you're considering?
So I think, we take a long view at Symantec. We are here for the long haul, and we invest in our technology and our employees and our customers. And, sometimes we get some headlines, rumors, and speculations, and our policy is not to comment.
Now, activist investor Starboard took a stake in the company earlier this year and has nominated several board members to the company. What has their impact been?
So I think the individuals from Starboard are excellent. We have been working very well with them, and I think we're very happy with their contribution in the boardroom.
You've been happy with the contributions.
Yes.
Can you give some examples of the effect they've had on the direction of the company?
Well, I think professionals like Dale Fuller have a great background in security, having come from McAfee and AVG, so he's definitely a big help. And Rick Hill is a very solid operator, and we enjoy their contribution.
Analysts are speculating that the company may struggle to overcome some sales growth challenges in the near term, and now that the internal audit has closed up and Starboard is part of the company, that they may push for the company to consider strategic options. Can you provide any more color around that?
Yeah, I think we look forward to delivering against our guidance from our last conference call. We think we've got a very good setup in our products and our technology, and Starboard members are a great add, and I think we're focused on our customers, focused on the future of the business, and happy with how things are going.
Now, there's been huge scrutiny on tech companies over the past year, especially around data privacy breaches, most notably Facebook's Cambridge Analytica scandal. And now we're seeing Europe institute GDPR, and I know Symantec has been helping companies through this. I mean, how effective do you think that policy is?
So I think data protection is something that corporations care about. You're responsible for your users, you're responsible for whether they're employees, customers, guests. And when you're a custodian of that data, you have to take it very seriously. At Symantec, we make some powerful data protection technology, and we look forward to companies embracing taking care of their data under GDPR. We think it's a strong tailwind for the company.
Now, I'm sure fears of cyber warfare and data breaches have been driving security spending by companies. What are some of the biggest emerging threats that companies need to be aware of that you think are maybe not top of mind?
Yeah, so I think that tradecraft changes all the time, what we call tradecraft methods for breaching companies. And I think it's important when you're thinking about your security partners to really look at their investments, where they're investing, the things that are important. At Symantec, we do over-the-horizon research for what's going to come next and next after that. Things like what happens when quantum comes, what happens in the supply chain now of software, what happens when everything's mobile on closed operating systems, and what happens when there's a dark internet. And I think that as we go forward, we will see many changes to the attack surface, and the kind of things we need to protect will be different. And so I think at Symantec, we look forward to being a long-term cyber defense partner for all of our customers and all of the normal citizens in the world and our consumer brands. And I think it's a vibrant road ahead for us.
That was Symantec CEO Greg Clark speaking with Bloomberg's Selena Wang. And that does it for this edition of Bloomberg Technology. On Monday, we'll be at the Techonomy Conference in Half Moon Bay, where we'll have an exclusive interview with the Micron CEO. I'm Alex Barinka. This is Bloomberg.